We just got three pieces of economic data which will help give you some insight as to where our economy is and where our economy is going. Number one is we got some data from the Federal Reserve Bank about the health of inflation. Number two, we got some data about the health of banks in the United States. And number three, we got some data on the health of consumers and consumer spending. Let me start by talking about what the Federal Reserve Bank said, because just yesterday we got the Federal Reserve Bank meeting minutes. And what it said is we still have a fight on inflation ahead. What it said is, quote, most in the meeting cited significant upside risks to inflation, which could require further tightening of monetary policy. What does that mean? We have seen inflation fall off of its highs. But if you remember from the latest inflation report, inflation actually went a little bit higher last month as opposed to the previous month. So we've been seeing inflation fall consistently, and then last month we saw inflation go up a little bit, which is where the Federal Reserve Bank is saying we could see more upside on the inflation side of things, which means we could still have a fight on inflation ahead, which means we might have to raise interest rates even more, which would have an impact on the economy and borrowing. And going on, this is where we have a little bit of debate inside of the Federal Reserve Bank, because some people in the Fed are saying, no, we need to stop raising interest rates because it's going to really hurt the economy. And then you have other officials in the Fed saying, we need to keep interest rates high, maybe even raise interest rates more, because if we don't tame inflation now, it is going to cause way more damage to our currency and our economy in the future. What is said is that some members of the Federal Reserve Bank urge caution, quote, the possibility that the macroeconomic effects of the tightening in financial conditions, aka higher interest rates, since the beginning of last year could prove more substantial than anticipated, aka you have some Federal Reserve Bank officials saying that we raised interest rates by over 5% in the last 18 months. This is the fastest we've raised interest rates really in modern history. These are the highest interest rates we have seen in more than 20 years. And because of how fast we raised interest rates, there's going to be a cumulative effect. But on the flip side, you have other officials saying, well, if we don't get it under control right now, it's going to cause bigger problems, currency issues, and economic issues in the future. And this is where what the meeting said is, quote, we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably to our 2% target, and we're prepared to further tighten if that's appropriate. So the Federal Reserve Bank publicly is saying that we don't know what we're going to do yet. We want to keep interest rates high right now, and we might raise them again in the future. And this is important to understand because it tells us, one, how is inflation going to affect the consumer? You'll see why this is important when we talk about the consumer spending side of things. And number two, how is that going to affect banks? Which brings me to the second part of this video. What's going on with banks? Because if you remember, we had a couple things happen in the past 2 weeks. First, Fitch, who's one of the three major global credit rating agencies, downgraded the United States from a AAA rating to AA plus rating. Then, about a week ago, Moody's, who is the second of three major global credit rating agencies, downgraded 10 banks in the United States and said that they could potentially be downgrading 6 other larger banks and lenders in the United States. Well, Moody's put up another statement. And what they said is that they, quote, lowered their operating environment score for United States banks from AA to AA minus because of downward pressure on the United States sovereign rating, gaps in the regulatory framework, and structural uncertainty around the normalization of monetary policy, aka changes in the economy, worries about higher interest rates, and worries about lower profitability for banks is making Moody's worried about the health of banks. So now you have Fitch, one of the three major credit rating agencies, worried about the health of the United States credit. You have Moody's, who's really focused on the health of banks in the United States. And this is where the big headline on the news, if you saw it yesterday, was essentially Moody's might be downgrading big banks like JP Morgan Chase Bank. Now, I looked deep into kind of what they said, and I do want to highlight that specifically because what they said was they're going to review JP Morgan Chase Bank and could potentially downgrade them if they saw more risks there. So just understand that some people kind of took the headline that Moody's might be downgrading JP Morgan Chase Bank as they're already worried about them, when in reality, they are going to do the analysis on JP Morgan Chase Bank, and if they see more red flags, well, then they could downgrade them. But the concern here is that Moody's is talking about how many banks are facing issues because of the higher interest rates. Here's what they said. Most banks' deposits were flat or down only modestly. but the mix worsened with non-interest bearing deposits declining and banks paying more deposits. What that means is you have a lot of money or a lot of people moving their money out of low interest rate accounts, which is a good thing because if your bank savings account is paying you 0.05%, which is what a lot of traditional banks are paying, people are now pulling their cash out of these low interest savings accounts and they're moving them to higher interest rate savings accounts or CDs, which are paying them 4 or 5% right now. Like I have a number of high interest savings accounts that are paying me upwards of 5% today. They're FDIC insured, they're bank accounts, I can pull my money out anytime that I want, but they're paying 5% versus traditional banks are paying 0.05. And this is where what Moody's is saying is this is causing issues for banks because a bank doesn't have infinite money. I mean, they kind of do because of fractional reserve lending, but at the same time, they rely on your deposits in order to lend money. So when a bank goes out and lends money to you to buy a home for 7.5%, or they lend you money to buy a car, or they lend you money to get credit card debt, they want to pay out the least amount of money possible. They want to pay you 0.05% and they want to charge you 7%. But now what they're saying is a lot of people are moving their money out of these low interest accounts and people are not borrowing money the way that they were before. People are not getting mortgages at the way that they were before because interest rates are so much higher. So banks are paying out more money, but they're not generating as much money, which is hurting the profitability of banks. This is one of the things that we've been covering in Market Briefs, which is my free financial newsletter. If you have not joined Market Briefs yet, it's a free and easy way for you to stay up to date on what's happening in the top finance and business news. You can read the newsletter in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I got the link for you down in the description below, or you can go to briefs.co/market. That's briefs.co/market. So we have the Federal Reserve Bank saying we don't know what's going to go on. By the way, next week, the Federal Reserve Bank is hosting an event at Jackson Hole, which is a pretty big conference that they host. So that'll give us some interesting insight as to what the Fed is thinking currently about inflation and what they want to do with interest rates. Then we have Moody and their concerns about the banking sector. And then we have what's going on in the consumer sector. And this one, I'm going to take a little bit of a tangent because Target, who is one of the largest retailers, stores in the United States, reported their earnings. And one of the things that they talked about was the health of the consumer. And what they said is essentially, well, consumers don't have enough money to keep spending. And that's why they downgraded their outlook for their growth and their profitability over the next year. And the reason why is because Target is saying is that people are spending so much more money on groceries and beverages because of the higher inflation that they have less money to spend other places, which is hurting Target's profitability. What they said is, as we look at the consumer landscape today, we recognize the consumer is still challenged by the levels of inflation that they're seeing in food and beverage and household essentials. So that's absorbing a much bigger portion of their budget. So people are going to Target. This is Target, but you're seeing it in other stores as well. And they're spending more of their income on things like food, drinks, and other essentials, which means they have less money to spend on other items, which are higher profit margin for Target, because those household essentials, things like groceries, things like your beverages, are generally lower profit margin. Those are to get you into the door, to get you to go and buy the other higher ticket items, the higher margin items, the more money making items for Target. But what they're saying is that the impact of the inflation that we've been seeing over the last number of years is now catching up to consumers. And we've been seeing this in a number of different ways. We saw credit card debt break a brand new high in the last week or so, over $1 trillion for the credit card debt. We've seen a new report by Bank of America saying that Americans are pulling more money out of the 401k with something called hardship withdrawals. We saw a 36% jump in 401k hardship withdrawals over the last 12 months. We're seeing more Americans dig into their savings to continue spending their money. And then we have Wells Fargo that said, if you have equity in your homes, this is a great time for you to pull cash out of your home. That way you can continue spending your money. So yeah, we're definitely seeing a shift in the consumer. And the reason why this matters is because, well, if we go back to what I said in the beginning part of this video, the Federal Reserve Bank is saying that they still have an upward hill battle against inflation. Well, what's causing the slowdown in consumer spending? Or not necessarily even the slowdown yet. We're still seeing strong consumer spending. But what's causing the shift in consumer spending? Inflation. And so you have, on one hand, you have banks saying, hey, it's okay, just go into debt or pull cash out of your home. or pull cash out of your 401k to keep spending and keep buying the things that you want. But Target is saying, yeah, see, what's happening is people are spending money still, but they're spending more and more of their money on groceries and beverages that they need to survive, which means they have less money to spend on other things. So people are spending money still, but we're seeing that shift. And eventually, people won't be able to go deeper into credit card debt. If people start to pull more money out of their homes, people will lose equity in their homes. And so there's a limit to how much people can spend. How much is that limit? Well, we still have a lot of equity in homes. We have one of the largest equity amount in, I don't know, I forgot how many years, I read that today, but in years, the amount of equity in homes. So people have the ability to spend because of that. People still have room to spend on their credit cards. People still have room to pull money out of their savings, which is not good for the consumer, but that keeps the economy going. But you have to remember, there's a breaking point for all of this. And if the consumer runs out of the ability to spend, well, the whole economic machine stops moving. And this is where you have a lot of people talking about how October is going to be a turning point, because in October, the student loan payments also restart. But the government is talking about how there's going to be a little bit of leeway, which I don't want you to take as leeway, because your interest will be accruing starting in October. But once student loan payments restart and people actually have to start making student loan payments, which would be a year from October, you can bet there's going to really start being more pain, because that's going to allow the interest rate hikes to really accumulate in the economy. It's going to let the higher inflation really start to accumulate in the economy. And then you have the higher expenses, while now wages are not growing as fast as inflation. We saw a lot of wage growth in the last couple of years. We're seeing that wage growth really slow down. So this is where it's important for you to understand what's going on, be patient, but also work on building that financial education, because there is going to be changes ahead in our economy. And you want to be the one that understands it and can capitalize on it, not the one that gets hurt by it, but that requires you to be financially educated and prepared.